What are some of the potential tax changes that we all may see in the years ahead? We're going to attempt on the program today to sort of do a little reading of the tea leaves to hopefully give you some thoughts on what the future of taxes might be. Obviously, the current situation with COVID may very well drive what happens there. We're going to also attempt to read the tea leaves in sort of an apolitical manner, because a lot of these tax changes you're finding have support on both sides of the aisles in some respect. So we'll cover that here on the program. Welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on Sunday mornings at 9 a.m. on both the News Radio Orlando network along with 96.9 The Game. If you want to listen to us at any time outside of 9 to 10 a.m. on Sunday morning on the radio, well, you can simply join us on any of our podcast stations, whether that's YouTube, iTunes, Spotify, you name it, we're on there. Easy enough to find us. Just search Nelson Financial Planning. Received an accolade at the beginning of the year, naming us one of the top 25 financial planning podcasts on the World Wide Web. Now over 12,000 downloads of our program. So excited to have our podcast audience join us as well. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you change your life with a successful financial plan that provides you with peace of mind for the future. Before we get to all of those tax changes that we might expect in the years ahead, we thought we would share a little bit of a story of something we saw this past week. Now, you've certainly heard us talk about this on the program before, where the financial services industry has really done a good job at confusing investors. And they do it through a variety of ways, through labels and different descriptions that create confusion. I'm sure you've heard the different names out there. You can be a financial planner, you can be a financial advisor, you can be an investment advisor, you can be a stockbroker. I mean, the list goes on and on. And the financial services industry doesn't just stop there in terms of the name or the description of the person, but they even go so far as to create different labels for what investors ultimately pay. It might be a fee, it might be fee only, it might be fee based, it might be a commission, it might be a cost, it might be an advisory fee, it might be a quarterly fee, it might be an hourly fee. Again, the list goes on and on. Well, here's the reality. A cost is a cost. It doesn't matter what it's labeled. It doesn't matter what it's called. A cost is a cost. And understand that as an investor, your costs eat away at your return, right? I mean, if you're paying 1.5% versus 1%, then your cost is 50% higher than what it might otherwise be. And at the end of the day, that additional cost eats away at your return. And if it's eating away at your return, then guess what? Your return isn't as good as it could have been. And we've certainly talked about this on the program before, but one of the trends that we're seeing, particularly now during COVID, is even more disturbing than just that whole let's try and demystify all of these labels and all of these descriptions. And that is, during this period of time where we've got a pandemic, we've got an election, the nervousness among investors is very high. And so what we see is large cash positions in investor accounts, because cash is obviously the place you go to if you're nervous about the future. So we see that more and more. And whether that's people that have sort of sold assets and shifted to the more conservative side, or whether that's folks that just have cash that are just sort of waiting to invest. And so the reason that this is so important now is that because you have these high cash balances in investment accounts, one of the things that we're seeing that's been particularly disturbing is that we continue to see people paying costs, fees, expenses, whatever the case may be, based upon the total amount of assets that are in a particular account. And if that account holds a bunch of cash, well, then you're paying maybe 1.5% on a investment account that has a chunk of cash in it. Well, I can assure you, you ain't making 1.5% on that cash. So let me give you a specific example of exactly what we're talking about. And we're obviously going to change the names to protect the innocent. So this individual, person that we visited just this past week, we'll call his name Bob. Bob has an investment portfolio of about $500,000. So we're looking through Bob's statements. And again, all of this cost stuff is always buried on like page 28, 29 of all of these long statements. But if you know what you're looking for, you can kind of find it. And that's one of the exercises that we do an awful lot in the office, is help people understand what those costs are. So we go to page 28, 29 of the 30-page statement, and there it is. It's 1.5%. Well, that's already high. That's a whole nother issue. But what was even more disturbing about it is that Bob had 25% of his portfolio sitting in cash. But yet the 1.5% was being calculated on the full $500,000. That is just unbelievable that that is happening in the industry. And folks, that's happening on a regular basis. So the key takeaway on all of this is make sure that if you're paying a charge based upon the amount of money that you have in a particular account, make sure that that fee is not getting calculated on the cash portion of it. I mean, that's just unbelievable when you stop and think about that someone would have the gall to charge based upon a cash position in today's environment where cash levels are high. The interest rate that cash is paying is next to nothing. And at the end of the day, you're getting charged for it. That's just mind-boggling. So make sure you carefully check your statements and make sure that that fee is not hitting you on the cash portion. Look, if you've got cash in an investment portfolio, there should not be any compensation that you're paying to anybody if you've got cash sitting in a money market or a savings or something like that. That should not be part of the charge calculation that's being made on the account. So double check that. Make sure that's not happening to you. Just saw an example of someone having that happen to them just this past week. We know there's a lot more out there because it is something we see on an all too regular basis. So make sure you're double checking that. Cash should always be excluded from any ongoing compensation that you are paying to the individual that is assisting you with your finances. We're going to take a break. We get back from the break. We're going to attempt to read the tea leaves on tax change. This one's going to be tricky because everybody's going to read some political message in there, and we're trying to make this as apolitical as possible. So stay tuned and we'll see if we can read the tea leaves and achieve that. Coming up next here on Dollars and Cents, this is Joel Garris on News Radio Orlando along with 96.9 The Game. Are some of the potential tax changes you could see in the years ahead. Last week we talked about some of the unique risks that retirees face, and one of them that we mentioned was actually low taxes. And a lot of people thought, well, low taxes, that would be a good thing. The problem is that if you're in an era of low taxes, a 100-year lows in terms of tax rates. The risk of those taxes increasing is certainly readily apparent, particularly when you go through a pandemic and kind of have to borrow a whole lot more money than you ever planned on doing. And so consequently, when you think of that, the concern going forward is that taxes might very well be going up, and in a lot of cases probably need to, in terms of trying to generate revenue for the government. So this segment of the program, we're going to attempt to kind of read the tea leaves of what those tax changes might be, and also try and address the likelihood of them actually coming in to existence. So there's 7 different pieces of this. We'll break down each one. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So when we talk about tax changes, there's certainly a lot of places where you could see some tax changes, and certainly there's a lot of conversation out there, particularly as we approach an election, where there's a lot of proposals out there that talk about raising taxes. And at the end of the day, and this is something that we've certainly shared with our clients, the reality is that oftentimes economic and tax policy respond to more the situation that is occurring in the midst of an administration, rather than sort of this hard and fast line of what exactly something is going to do. I think oftentimes politicians run on a platform, but then when they get into office, the reality of the current economic situation always sort of kind of overtakes whatever plans that they might have had. And I think certainly we could see that as well, particularly with the COVID pandemic and the economic implications that have come from that, particularly with the massive amount of things that have had to be done, particularly with borrowing more money on a federal government level. So our thesis on this really is that regardless of who is elected, we doubt that the status quo is going to continue. And so what we want to put on the table is some of the changes that have been talked about out there, and whether they're going to have an impact or what sort of the likelihood is that they're going to happen. And at the end of the day, a lot of these tax changes have to deal with increases on high income levels, like over 400,000, over $1 million, those kinds of high impact levels. So for the vast majority of Americans, you won't necessarily see as direct impact. There's obviously still ways that with tax changes, it can increase your tax bill no matter what. A good example of that is the change to that higher standard deduction that happened a couple of years ago. If you were one of those taxpayers that itemized a lot, had a large amount of real estate taxes, or large medical expenses, or large charitable giving, or even was someone who worked from home and had a lot of unreimbursed employee expenses, they moved to a standard deduction, eliminated the unreimbursed employee expenses, and it effectively reduced the amount of real estate taxes and income taxes you could deduct. So that meant that your taxes were going up, even though there was these tax changes that went to a higher standard deduction. You would think, oh, well, that's not going to necessarily affect me. And the reality is that it can. So just understand that any tax change obviously has a ripple effect. So let's get into sort of the 7 areas of where we see this conversation sort of focusing on in terms of tax changes. And the reality is that we're sort of trying to read these tea leaves in a somewhat apolitical type of manner. So anyway, so we'll start with the first thing, the corporate income tax rate. So that has gotten lowered down to 21%. Should we ultimately see that increase? I would say the most likely answer there is you're probably going to see that increase, but not back to the previous level. Understand that prior to 2017, the corporate tax rate in this country was 35%. No one is suggesting that we go back to that. I think you'll probably see a number somewhere between the current rate at 21 and the previous rate at 35. So those would be kind of the shift of what you would see on a corporate tax rate. The reality is that have a major impact? And I guess given that the tax rate was 35% and the tax rate going forward might be less than that, I don't know if that has as big of an impact as folks might really see. The next one probably does have an impact if you fall within those businesses that were likely to take advantage of the Section 199 qualified business interest income. This was unique. It started in 2018. It allowed for a 20% reduction off of that qualified business income that was passed through. It did not have an income limitation. That one had the biggest impact on small business owners. So I don't know that you'll see a whole lot of change on that one. Maybe you'll see sort of an income limitation. There's been conversation around the 400,000 income level, meaning above that you don't get the qualified business income deduction. But if you're below that, you would still get that. And again, I think that one's going to be more driven by COVID and the struggles that small businesses are going to have in terms of getting through the environment economically. So I don't know that you would find a deduction that goes dramatically more towards small businesses getting eliminated, but perhaps it gets limited based upon a total income level. So look for a conversation about that qualified business income deduction. Next up is obviously the tax rate. Prior to 2018, the highest tax rate was 39.6. That got lowered to 37%. Most likely see that move back up to the 39.6%. The reality is, just so you understand where those income limits are, that highest possible tax rate kicks in married filing joint return at above about $630,000. So again, these big tax changes that we talk about, oftentimes I think they're going to represent a return to the levels of where things were back in 2017. Obviously, those are some very high income levels where your joint return above $630,000, if you're single, above $530,000. That's where sort of those tax rates kind of kick in, if you will. The next one up is one that has to deal with capital gains. I'm not sure that you'll see this one really change. It's interesting if you look at capital gain rates and the rates on qualified dividend rates. If you go back through history, the lower tax rates on qualified dividends and long-term capital gains that we see were actually as a result of changes that happened in the Bush administration. And then because of the economic climate coming out of 2008, 2009, that the Obama administration had to deal with, that they actually talked about changing it, but they actually wound up not changing that. So the notion of qualified dividends and long-term capital gains being treated at lower tax rates is something that has actually spanned both Republican and Democratic administrations. So we think that one still continues to have some legs because that really helps out retirees, right? If you're drawing money from an investment portfolio and using dividends and capital gains and things like that, and you've got lower tax rates on that, then that obviously helps you retain more of your income for retirement. So the conversation about capital gains getting taxed at ordinary income, that probably is a limited conversation based upon incomes above a certain threshold. And the threshold that's been talked about in this particular case is above $1 million. So if you're above $1 million in terms of income, you may see your capital gains rate go from 20% and be taxed at ordinary income, which could be as much as 39.6. The problem with that, though, is that really does pick up small business owners who have that single occurrence of retiring, selling their business, and ultimately they would wind up being hit at a much higher level for sort of those one-time transaction. So hopefully the folks in Washington would kind of put some caveats in there where maybe you can get a one-time exception or something like that, much like what used to happen with the sale of your primary residence, where you would get sort of a one-time exemption from the buildup in capital gain. Perhaps there'll be some special exceptions on that as well. So those are sort of the first four. We've got another three to go through. We're going to go take a break, and when we come back from the break, we're going to kind of continue this conversation on some of the potential tax changes that we might very well see in the years ahead. So stay tuned through the break here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando. Talking about some of the potential tax changes that we all might see over the course of the next few years ahead. Obviously, COVID had a significant impact on this country's finances, but you also have to recognize that we are at 100-year lows in terms of tax rates. So certainly some interesting dynamics that are playing out there with where we sort of are on a historical basis, and then rolling in the unexpected nature of a pandemic and what it has caused this country to have to do in terms of borrowing money. I mean, the debt load in this country has increased by about 30-40% as a result of some of these responses to the COVID pandemic. So on the program today, we are sort of working through some of the tax changes that appear to be floating around out there. Most of them are going to be limited to very high incomes above 400,000, above $1 million, above 600,000, depending upon which tax change you're talking about. We sort of broke down half of them before the break. Corporate income taxes was one of them. Regular ordinary income tax rates another. The Section 199 qualified business interest or qualified business income deduction was the other. And then this notion of capital gains above certain income levels being taxed as ordinary income, and sort of try to kind of give you a little bit of a prediction, if you will, of what might actually happen versus what the proposals are. We do think that corporate tax rates could creep up a little bit, but not obviously get to the level that they were prior to 2018. We think the highest marginal income tax rate is ripe for an increase as well. Obviously, that hits incomes above 600,000 on a married joint return, 500 and change on a single return. Qualified business income deduction might not hit that much because that has a tendency to hit more directly with small business owners who are certainly suffering as a result of the COVID pandemic and the related government shutdowns. The other one, taxing capital gains as ordinary income, pretty high levels of income that is being floated around about above $1 million, that change might happen. And that's $1 million of income that you're reporting on your tax return in a given year. It's not whether you've got $1 million or not. It is income, reporting income at above $1 million. Obviously, that's some pretty high levels. So those are the things that are kind of getting floated around. I would expect on that capital gain item to maybe see some exception for one-time sales, those kinds of things. So we've got a few more to kind of work through here on next up in terms of the tax changes that we might expect over the next few years. So welcome back to the program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you simultaneously on the News Radio WFLA Orlando network, along with 96.9 The Game. Got a Bucks game coming up this afternoon. I think they got the late game, 4 o'clock. And we're also one of the top 25 financial planning podcasts on the World Wide Web. Over 12,000 downloads of our program at last count. My name is Joel Garris, certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready to help you this week change your life with a successful financial plan that provides you with peace of mind for the future. So One of the biggest issues in this country is the projected shortfall when you look at Social Security, Medicare, Medicaid. I don't think that's any surprise to anybody that those programs need some shoring up. And at the end of the day, those programs are the ones that the vast majority of Americans, particularly when they get to retirement age, really rely on for a portion of their income. Hopefully you're not relying on it for all of your income. At the end of the day, Social Security was only intended to replace about 30-40% of your income. So you got to make sure that you're also saving money along the way to help supplement that Social Security. But we all know the reports and out of Social Security that say that, hey, they're going to be running short of money and not being able to pay the full amount of benefits as they've been promised within not a very long period of time from now. So one of the things that you hear about, which I do think we'll see some form of this happen regardless of administration, is that you've got to do something with the taxes and collecting taxes, particularly Social Security taxes. Some of the proposals out there have to deal with a what is known as a donut hole, which basically right now you pay 12.4%, or what is paid is 12.4% of every dollar of earned income you make up to, for this year, about $137,700. Now that 12.4% is split between you and your employer. Each of you pay 6.2%. And the reality is, above $137,700, then you're done. You don't pay any more in Social Security taxes. And so the conversation in Washington, and has been for decades, is to start to reimpose those Social Security taxes at higher income levels, where you have a donut hole where you don't have to pay Social Security taxes once you're above $137,700, but then somewhere at, pick your number, 400,000, 500,000, 600,000, then the requirement to pay those Social Security taxes would then start kicking in. I would put that one in the likely category simply because of the condition that the Social Security program is in a way to try and generate some additional revenue for it. Next up is the deduction category. We talked a little bit about that in the last segment. When you move to the higher standard deduction, there were a number of deductions that people used to get that were eliminated. Chief among them, which turns out to be pretty important during a COVID pandemic that locks everybody in their house, is the notion of being able to write off unreimbursed employee expenses. So let's say you're working from home right now and you bought a laptop, or you increased the speed of your internet, or you did any of those kinds of things, buying a printer, whatever. Those deductions as a W-2 employee, you don't get to write off. That's the reality of the higher standard deduction tax changes that happen. So for those people that are impacted by that, they don't get a deduction for that anymore. Similarly, if you pay a bunch in real estate taxes and things like that, maybe you bought a second home to escape from the craziness of a COVID lockdown, and so your second home, though, you're limited in terms of being able to write off the real estate taxes. So a lot of those types of changes that happen with deductions, you could see us revert back to a simple, you get to write off these types of deductions. So you may find that you get a broader range of things in which you are able to write off, but the amount of deductions that you are able to write off is limited to, say, like a 28% number, or a 25% number, or a 30% number, in terms of sort of what the cumulative effect that they can do. You're not going to be allowed to write off deductions that absorbs 100% of your income, but rather see them capped at a amount that is equal to your adjusted gross income. So that could very well be one of those tax changes that you see. And then the last one that's getting talked a lot about, which I certainly hope, I don't know that it's got a lot of legs to run on, is this notion of eliminating a step up in basis. And how that works is, let's say that your parents bought ExxonMobil when it was $20 a share, and now obviously it's much, much more than that. And so there is a gain in there that when someone dies, that gain, that basis, if you will, steps up to the value at the time that they died. And that effectively means that you don't have to worry about the capital gain anymore. And that's a big way that assets pass and avoid taxation. So understandably, folks in Washington kind of looking at that and saying, well, if that only hits people when they die, they're dead, nobody really knows because they're dead. Maybe that's a way in which that we can ultimately generate some additional tax revenue. And I think this one, though, has an impact that affects people no matter the income level. I mean, if you inherit something that has a low basis and then you try and sell it, that's going to be a gain. That's going to affect everybody at a variety of income levels. But again, that type of proposal has obviously been around for decades as well, is to eliminate that step up in basis. We don't think that there's a high likelihood on that one because it does affect a much broader cross-section of individuals. So if you're reading the tea leaves on the tax changes that might very well happen in the years ahead, sort of beyond the current presidential cycle, I mean, these are tax changes that we would expect to see over the next decade. So think over the course of the next 2 or 3 presidential elections, what are some of the things that we might very well see? A lot of these aren't necessarily new concepts. They've been around for a while and floated back and forth between Democrat or Republican administrations. But as we see the debt in this country continue to rise, largely as a result of COVID sort of accelerating it, do some of these actually stand now a better likelihood of happening over the course of the next 5 years? And so we think that there is certainly something to be discussed so that people can start to think about, okay, what does that look like and what's the potential impact that could have on me? So hopefully that gave you at least some background, at least some things to think about. Obviously, as those tax changes become, or those tax change proposals become realities, that's when we'll certainly be talking a lot more about it on the program and the strategies to try and address things. I think bottom line is, you know what the tax rates are for this year, 2020. So if there's something that you're thinking about doing, you may want to get it into this year rather than take a wait and see approach for next year in terms of what the tax rates are. So with that, we'll take a break. When we return from the break, we're going to talk about another way that the folks at the IRS can generate income beyond just changing the tax rates. Coming up next on the program, this is Dollars and Cents with Joel Garris on News Radio WFLA Orlando. The program about some of the tax changes to expect in the years ahead, and surely that's one way to raise revenue, right? You change tax rates. The other way is to increase enforcement. So if you've bought or sold Bitcoin or any other kind of cryptocurrency out there, you really need to listen to this segment of the program. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on Sunday mornings at 9 a.m. to 10 a.m. So we're about ready to, this is our last segment of the program here on News Radio Orlando Network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So if you're interested in catching us during any other time of the week, you can check out our podcast on all the various channels out there: YouTube, Spotify, iTunes, you name it. We are on it. My name is Joel Garris, Certified Financial Planner, Certified Financial Fiduciary at Nelson Financial Planning, where our team of Certified Financial Fiduciary stands ready this very week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So when you do your 2020 taxes, the IRS is planning a little bit of a surprise for you. So listen up to this one. They're going to put an additional question on the return. And no, it's not the one about whether you want to contribute $3 to, the presidential election campaign. Who does that, by the way? Anyway, the reality is that this question will be put in an equally, probably even more prominent position directly below the name and address. There's no way you're not going to see this one. And the question is going to be, at any time during the year 2020, did you sell, receive, send, exchange, or otherwise acquire any financial interests in any virtual currency? And you must answer yes or no. Why would they do this? Well, there's 3 good reasons why they're going to do this. Number 1, they want their taxes. And the reality is that, understand sort of the issue here. The IRS looks at currency and Bitcoin and those types of things as property. And so when you buy or sell property, you're recognizing a gain or loss depending upon whether you bought it at $10 and then subsequently sold it at 15, or whether you bought it at 15 and then subsequently sold it at 10. The IRS wants to know that, and what are the attractiveness, if you will, of virtual currency is the fact that it is untraceable. So when you buy it and then sell it, you wouldn't necessarily know about the transaction. So just for reference points, 1 Bitcoin today is worth over $10,600. So that's a whole lot of money that's kind of getting swapped around. And at the end of the day, it is definitely a strong warning by the IRS to folks that buy and sell that stuff that they're going to have to start filing the required forms and doing paying the applicable taxes going forward. Number 2, when you sign the return, you're signing the return under penalties of perjury. So if you say you didn't do anything with cryptocurrency and you did, that's no way you're going to be able to avoid it. And then number 3, this approach has worked before. Starting in 2009, the simple question about offshore accounts created a crackdown on Americans that had money offshore, that had money out of the country. So far, that alone has brought in $12 billion to the IRS. So it's a reality is that the IRS definitely sees cryptocurrency and trading in that stuff to be a big aspect of what's going on out there, whether it's the small-time enthusiast who's doing it as a hobby or the highly sophisticated criminals that are out there doing it. And it is large numbers, folks, on this stuff. So we're going to share those large numbers with you, but we'll have to do that on another program. So we'll wrap it up and get on out of here. Thanks for listening on in to Dollars and Cents. This has been Joel Garris on News Radio, WFLA, Orlando, along with 96.9 The Game.